Everybody's here. Should we do some clicker action? Okay. We haven't done that for a while. So, okay. Okay, we are almost there. Everybody has it? It's okay if you answer B. Okay. Okay. So everybody done? Everybody? Okay. All right. Yes, that's one of the few times. Yeah. Okay. So, so our topic today is evaluating governmental financial performance. And by now, most of you probably do know the types of indicators which usually can spell trouble. And one of them, take a guess, who might want to give me an indicator which could spell some issues or problems with a government, which we just covered in Chapter 8, a huge area. Unfunded pension liabilities. Remember we talked about that, the net pension obligation. So what I want you to do is, the way we're going to look at this chapter is we're going to define some terms first. And after that, we're going to take a look at some methodologies that are used to evaluate government financial performance. And then we'll take a look at the data which is used to evaluate government financial performance. So first, some definitions, then some methodology, and third, try to understand what those indicators are, okay? And as I said, it really isn't a difficult area, but you do need to understand something about what you have studied so far, governmental accounting, to respond to some of these questions. So we'll take a look at the differences between these three terms: governmental financial position, financial condition, and economic condition. And they sound the same, but they are not. And we'll talk about that. We'll then talk about this ICMA model, which takes into account three different types of factors, which is ICMA is the International Cities Management Association. We'll take a look at the ratio, and finally we'll end up with benchmarks. Okay, so that's kind of our agenda. So to start off, do you think local governments and state governments in the U.S. Face substantial financial challenges? Yes or no? And why do you think that is so? Why do you think that we have, well, it has to do a lot with, and this is what it comes down to the model. It has to do a lot with the way things are run, management practices. It has to do with politics and the need to get reelected. And it has to do with people, folks simply wanting to pay the least amount of taxes they can, right? So it's a combination of things, and this has happened over many, many years. And that's what we'll talk about. So the question is, why evaluate government financial performance? Well, as I said to you, the reason is, and you can look at it, and this is what you need to do. You need to put yourself in a position to say, where do you belong in this review? Are you a bond analyst? Are you a taxpayer? Are you a newspaper reporter? Are you a teacher in a school system? So you need to really look at it from which angle you come in. And the reason is the following. If you were a bond analyst for Moody's rating New Jersey's debt, what would you like to see? You'd like to see sufficient revenues, right? That are raised through taxation so that your debt can be paid. If you are the taxpayer, what would you like to see then? Low taxes, right? Do those two objectives meet? And that's the issue. And that's what makes things a little tricky, is that the interest of one party is not necessarily the interest of the other party. So the bond analyst might look at the situation in one way, but the taxpayer might look at it from a different way. Now, as far as early warning systems, and this is, I've tried to bring as much practical aspect to this course as possible throughout the semester. In New Jersey has a very strong system for detecting fiscal stress, and it does it through a division called, and it's, who would ever think that? It's called Division of Local Government Services. It's a division of the state, which what it does is it monitors the financial condition of every single governmental entity in the state, municipalities, counties, and it has the power. For instance, we saw that several years ago, where the city of Camden couldn't meet its bills, and New Jersey took over the city, literally. They have these really very strong powers to be able to literally go into a town, fire everybody, and take over the administration of the town itself. So New Jersey has that, but many states do not have that. And for that reason, taxpayers are much more actively involved because everybody read the story about Stockton, California, and the bankruptcy. And if you haven't, you should take a look at it because municipalities and towns are allowed to go into bankruptcy. You wouldn't think so, but they are. And when bankruptcy occurs, very strange things happen because, and city of Stockton in California as an example, if you can, please do take a look at that. Okay, so these are the folks that are interested in evaluating government financial condition: managers, bond investors, creditors, legislators, citizens, taxpayers, and all the others. And as I said, they each have their own interest. So let's go back to our very first chapter. What was the most important thing that we learned behind government financial reporting was the word accountability, right? Remember that? And there was another term that I used, which was inter-period equity. And this is where the problems come in, because everybody understands accountability, but inter-period equity people get lost in. And this is what happens. And I'll go through this concept again. If you borrow money personally and use it to go out on a vacation, and that money that you're drawing upon is money that is to be earned next year, what are you doing? You're violating inter-period equity principles, which is what's happening. You're using revenues to fund expenditures from another year, or expenditures are being funded through revenues in future years. And this is one of the biggest issues we have in government is this inter-period equity issue. So in terms of the bond analyst, what do they want to do? They want to make sure that bond debt service payments will be covered, that the entity continues to serve its citizens at a certain level of service. And anybody read about Detroit lately? What's happening there? And they're going through some financial problems, and if I have time, we'll talk about that, because everything that you see going on there is what we have talked about in this class. Okay. I don't think there's much of a problem in terms of compliance with laws and regulations, because we know that if the municipal officials don't comply with laws and regulations, there's one place that they go where they don't want to go, right? And so, either they are fined or it's a misdemeanor. So let's take a look at some of the basic terms. And very important that you don't get these terms confused, okay? The first is financial position. Financial position is a term, think of it as a short, as an indicator that's looked at it in a shorter term, immediate term. Because what do you talk about? You talk about focus on assets and liabilities that require cash or are normally converted to cash in the short term, or liquidity, okay? So this is a much shorter term indicator. Financial condition is a more broad encompassing one, because now not only do you need to meet the obligations to creditors, but you also need to meet your service obligations. And this is where people are, some people do complain and some people don't complain about GASB. Remember, all the information we've looked at, it's all financial, right? There is a statistical section, but GASB doesn't concentrate on performance data. It tried to, but they got a lot of real resistance from CFOs who didn't want to go into that area. How could you measure the performance of a government without looking at the inputs and the outputs? If you only look at the inputs, what doesn't do anything? So what we have is this financial condition, which now also attempts to measure the service obligations to the constituency, now and in the future. It's no good if you can provide this year and you can't provide services in the future. What have we seen in governments? We have seen a decline in future services, right? We've seen this gradual decline in services. And finally, economic condition. Now, GASB uses an interesting approach for this, because what it does is it combines both of these two into something called economic condition. It captures a composite of the government's financial position and its ability to meet its financial obligations on a pay-as-you-go basis. GASB actually has two publications. For those of you who ever go out in the governmental arena, there are two publications you should get. And those two publications are mentioned in the book. The first one is What You Should Know About Governmental Finance, Local Governmental Finance. Okay, that's the first one. And the second publication is An Analyst's Guide to Government Financial Statement. These two guides are wonderful because they are a crash course in a lot of what we have learned, and you don't have to worry about journal entries. It's just the financial statement analysis. The author of those two guides actually teaches for us at Rutgers. He teaches in our program, Dean Mead, who's a research manager, and we have a whole course on it, a whole course on what we are covering today, a semester-wide course on how this is done, taught by him. So this is a major, major area because, you have to, accountants shouldn't be just, so what's the difference between financial and managerial accounting? Financial accounting deals with what? What's happened, right? In the past. Would you be more interested in, yes, sure, we are interested in what's happened in the past, but what's managerial accounting? It deals with more the use of financial accounting data to do what? Manage or, come up with alternatives or to run the organization in an efficient manner. So that's where we're going with this. So along with this, we know the definition for financial position, but there's fiscal capacity and there's service capacity. These are just terms, couple of terms. There are not many, but these are terms you should be familiar with. Fiscal capacity is the ability and willingness to meet obligations as they come due. Fiscal meaning dollars, right? Fiscal means dollars, and service is ability and willingness to meet commitments and provide services to citizens. It's not too good if you raise the same amount of taxes and provide no services. And actually, in New Jersey, we see, there are some towns which provide more services than other towns. And this happens across the country. It's just not any one part. So I like you to understand the distinction between this, which is dollar-driven, and this, which is service-driven. Now, this is the model that ICMA talks about. These, yeah. Yep. Well, if you look at the financial condition itself, yes, they're very similar. Fiscal capacity is very similar to the differences between financial position and financial condition. That's where the big difference is. Because the financial position is what? Much more shorter term. It deals with the liquidity. It meets with immediate cash obligations. Okay? So this is what it is. You have financial position, which is short term. Financial condition, which is financial position plus service, providing service. Then we have GASB redefining, because GASB has its own term called economic condition, which takes financial position and financial condition and puts it into these two categories, fiscal capacity and service capacity. Okay. But just remember one thing. There are three different parts to this. One is immediate fiscal, immediate financial obligation. That's financial position. Second one is a broader measure, now and in the future. And the third is financial now and in the future along with service. I'll explain this to you. Does anybody else not get it, or do you want me to? I know the definition is, they all seem similar, but you need to just think of it this way. The GASB's definition covers everything that you saw, okay? ICMA, now look at this. They have come up with these different pieces. Cash solvency, ability to generate enough cash over a 30 or 60-day period to pay bills. Budgetary solvency, do you have enough revenues to cover your expenditures? Long run solvency, ability in the long run to pay all cost of doing business, and service level. See how close these are? The only thing new you see here is budgetary solvency, okay? But these are the four parts that are used by this International Cities Management Association to look at solvency. Okay? And it's interesting because this is short term, this is budgetary, this is long run, and this is service. Now there are three different factors, and there's a nice illustration actually in the book, I think. Here's that big chart. And a lot of this is really common sense. And maybe I shouldn't assume that, because having worked in the public sector, it makes common sense. But for some of you, it might not. And look at the way these things are organized. Environmental factors, organizational factors, and financial factors. A lot of us deal with this area. Financial, things that you can measure. When you talk about environmental factors, it becomes a little subjective, and when we talk about organizational factors, it becomes even more subjective. Okay, so what we're going to take a look at is each of these factors. This is what they use to evaluate the factors that go into the financial condition of an entity. Okay. Okay, now this is more like a course, not an accounting course. This seems a little different because we're talking about things that, and accountants like to measure everything, right? Well, this is something that might not be that easy to do, but there are interesting factors that you see here. The first one, community needs and resources. Remember, what are these factors? These are the factors that go into how that entity finally performs, or factors that affect it, okay? So the environmental factors themselves are obviously pretty obvious. Community needs and resources. This is an interesting story because, you have things like population, age, income, employment, crime rate. But the interesting part about this is, think about this. The greater the need for services, the lower the capacity to provide it. What does that mean? The greater the need for service, the lower the capacity to provide that service. Can somebody put that in more layman's term? What does that mean? What, Deepika? Well, it's the greater the need, the lower the capacity to supply it. So what do you see? The areas which have the greatest need for services have the tendency to do what? Have the least resources to provide it. It's kind of it's kind of a strange thing, but isn't that true? Isn't that what we see around? And that's what causes issues, with cities like Detroit and others, okay? And you see, the next one, intergovernmental constraints. What does that mean? Restriction on revenues. Now, intergovernmental constraints also apply to taxes. And this is how it does. I don't know if you know, in New Jersey, municipalities cannot raise their expenditures, their budgets, by more than 2%. Our governor put that into effect. So that's a intergovernmental constraint. Limitation. It started off in California and it's spread around the country now. So, and that's why we have some people who are not happy at all because of that. Because there's a limitation on how much you can raise your budget. If you cannot raise your budget, what happens to your taxes? Your taxes are not going to rise as much. Do you see that? And that's the constraint that's there. And there's also a constraint such as debt limit, which we talked about. The third one is disaster risk. And this is what we spoke about in the class, which was the issue with Hurricane or Storm Sandy, which is what happens there. Think about, for a moment, what happens when a storm like Sandy strikes the shore and you've got properties washed out, the municipality loses its tax base, and therefore what happens? Well, that's a disaster risk, right? Happens in Florida and in other parts, but that's another factor that's involved. Political culture, and this is something we can talk about for hours and hours because each one of us likes to look at it a certain way, is, there are certain areas of the country where people don't want their taxes raised a penny. They don't care what it is. And this is what comes down to school, the debates on schools. You ever hear, when you have to go out and vote in an election, the school election, the budget, to pass the budget, and what happens? The seniors go, and what do? Do they vote for it, or do they sink the budget? They basically say no. All the folks whose kids are going to schools, what do they want? They want the budgets to be approved so that kids can get a decent education. And what do they say in addition to that? Say, these guys who are voting down the budget now, didn't they have kids at one time? who had to go to school and who had to be paid for, because that's public education. So it's a tough issue. And political culture, as I said, can vary from area to area. There are some places which don't mind borrowing money. In fact, there are towns where anything they do, oh, let's go borrow money. And then there are towns which say, no, even though we have a debt limit, but we're not going to borrow. And that's your political culture there. And then external economic conditions, these are things that you can't control. You know, if the country has a high unemployment rate, well, there's so much you can do at the local level, you know. So those are the environmental factors. Organizational factors are management practices and legislative policies. And these are the questions which we've dealt with so far. These are the folks who are going to be making the decision, and that's what it means by management practices. Decisions on what? Funding pensions. Decisions on what else? You know, investing in capital assets. Decision on raising debt. You know, decision on undertaking maintenance, for instance. So these are management decisions, but these are important decisions, because without that, you know, if they're not properly made, somebody will have to pay that cost in the future. And this is where budget gimmicks come in. And I hope, if nothing else you get out of this class, is that if you look at a budget, you'll be able to figure a couple of things out, such as, you know, the issue with inter-period equity. You know, people borrowing. So if I came to you with a budget and said, I'd like to borrow some money, and the reason I'm borrowing money is to pay for some cost this year because we just don't have money, what would your answer be? Well, you know there is something fundamentally wrong with that, right? Because of the inter-period equity issue. Financial factors, these are the ones that you'll, you know, revenues, expenditures, operating position, debt structure, unfunded liabilities, and condition of capital plan. Revenues and expenditures, as I said, it depends on which side you come from. But generally, do you want increasing revenues or decreasing revenues? You want a gradually upward slope for revenues. Expenditures, how would you like them? Would you like them to stay stable, down, or up? And it depends. It depends because, but one thing you don't want is, what would you not want to see? Expenditures increasing at a rate faster than inflation or revenues, right? So you're getting the hang of it. Operating position, your fund balances. Would you like to have zero fund balance on your balance sheet? What's the fund balance used for, by the way? Well, it's like a rainy day fund, right? For some cash from, you know, short-term cash needs. So you want, the debate always has been, how much fund balance should I have? What percentage of my total operating cost for the year should be the fund balance? What do you think it should be? 3 months, 6 months, 9 months, or a year? What would you pick? How many pick 1 year? How many pick 9 months? 6 months? 3 months? And the rest are on strike. Okay. All right. But usually it's a number between 3 and 6 months. And the reason is it's a rainy day fund. And people would like to keep more, but the taxpayers don't want it, because that means that there is cash sitting there. Debt structure, short and long-term debt burden. What do we learn about debt? You need to match the debt with what it's financing. So if the asset has a productive life of 10 years, do you want a debt which is 20 years out in the future? No, what would you like? A 10. You like to match it just like businesses do, as much as possible. And condition of capital plan, you want to keep it up so you don't have a big issue later on. So what we're going to do next is talk about ratio analysis. And this is, the data for this will come from CAFR. There are two sources. What are the two sets of financial statements CAFR has? I know it's warm, guys, but you've got to just keep on, we'll keep on going because I'm going to lose steam. You have to respond, okay? So what is it? You have two sources. What are the two sets of financial statements? The fund financial statements and the government-wide. There are ratios which come from each one of them, okay? And that's what we'll be talking about. I know it's pretty warm in here, but we'll have to keep on going here. So what we're going to do is figure out how these ratios are calculated and then talk about how they are interpreted. But when you interpret something, what do you have to compare the result with? Some benchmark. And this is where people get into trouble with government financial analysis. What is the benchmark? Can I compare the results, operating results for the city of Newark with a suburban town? Benchmark. So it's a big issue as to size and socioeconomic condition. And we'll talk about that in a moment. So this is the data for calculating the financial ratios. This is where it comes from, the government-wide statements. The fund financial statements, the notes, the MD&A, the statistical sections, great, other publicly available resources. Now what I'd like you to do is you're going to now put a different hat on. You're going to put the hat on of an analyst who works for Moody's or Standard & Poor's. I'm going to change this. Now we're going to get into a more critical phase of how we do this. Now one thing is, let me just mention one other thing. In the government-wide, what did you have? Governmental activities and business-type activities, right? In many cases, business-type activities are excluded in the analysis. Why? Because they're supposed to be self-supporting. And so not to skew the numbers, we take them apart. And it's usually the governmental activities there that are looked at. Let's take a look at some of these measures. Revenue per capita. Operating revenues divided by population. How would you like to see that number? The ratio, more or less? Now, I'm going to pick up on some people now. So what do you think? Should the ratio be, what would be a favorable ratio for you? Higher number or lower number? Okay. And apparently it has to be, the question is it increasing or decreasing, right? So as you said, you want what? A higher number, right? How about one-time revenues? What would you like? Why would you say lower? Yes, because one-time revenue is one-time revenue, right? So you'll have to find a fix every year. And this is the problem we have with all the states. We have to find a fix every year, you know? So here, what do you want? You want to see one-time revenues as, you know, the least amount that you can find. But many states have used this to plug their budget deficits. Okay. Expenditure per capita, operating expenditure divided by population. Well, this is a tricky question because you need to look at the other side of the ledger. But what would you like to see here? Well, you want a smaller increase, as small an increase as possible, or one which doesn't, you know, you want to make sure that it's within the range of inflation that's experienced in that area. Yes, yes, no, you're right. And that's why what I'm trying to do is, remember I said to you, change your hat and put the Moody's analyst on, not from the taxpayer. I want you to look at it from the Moody's one. But, oh, okay, the bond rating agency. Okay, bond rating agency. All right, yeah. number of municipal employees divided by population. Okay, now this is, what would you like to see? A small number. Now, I'm going through these because I want you to understand these. I know they seem so obvious, but you should be able to understand the relationship between these. Okay. Operating surplus. Now, this is your question. This is where you should be asking me the question. Operating surplus divided by operating revenues. If you were the bond rating agency, what would you like to see? A greater surplus, because that does what? Provides you greater security. If you were the taxpayer, what would you like to see? The smaller one, because you want your tax rate to be down. Okay. Fund balance, general fund balance divided by operating revenues, and this is what I was saying to you. This is a subjective number, but there's one thing, and nobody asked me this question, is as I ask you this question, I'm always asking you this at a point in time, right? Do you want to always see things measured at a point in time? What would you like to see things measured as in, or a range of time, right? And that's, in government financial analysis, that's very important, because what you want to do is look at these ratios over a period of time, not at just one moment. And I use this as an example, general fund balance. If you have a declining fund balance over the past 10 years, is that good or bad? Well, that's not too good, right? If you have a stable fund balance, it's fine. If you have an increasing fund balance, you've got some very happy citizens who don't mind, okay? But you need to look at this over a period of time. Liquidity, cash and short term, okay? Well, this is, do you remember your quick ratio? What was quick ratio? I'm trying to remember. Yeah. That was current ratio, quick ratio. That's right. It's the immediate cash, right, and marketable securities divided by current. So this is, in this case, usually what you need to remember is that if this ratio is less than 1, you're going to have a problem, right? If this ratio is less than 1, you will have a problem, because, and when you have that problem, what do you do then? You go out and borrow money, right? Tax anticipation note or some other short form of financing. Okay, next one, general obligation, long-term debt divided by assessed valuation, or population or personal income. What do you think this means first? Think about what it means. Your debt divided by your assessed valuation. Do you remember seeing this somewhere else? Remember when we were trying to calculate the debt limit, which was based on what? A percentage of the assessed valuation? That was where we saw this. So in this case, would you like a higher number or a lower number? Do you want a lot of debt? Think about this. Look at the ratio. A little bit more difficult to understand, but debt divided by assessed valuation. So you want a lower number, right? So a lower ratio is better. Next one, current liabilities. Current liabilities divided by operating revenues. That's kind of an interesting ratio, because what does that mean? What's current liabilities represented in a government? That's all your payables, right? Okay, so your operating revenues are for what? The entire year, right? So now think about this. 1 month's worth of payables would be what? 1/12, right? Approximately, of your revenues, right? So here the factor that we use is that if this number is greater than 5%, this number is greater than 5%, it could mean trouble. Okay. Because you have too many current liabilities in relation to your operating revenues themselves. This one I think most of you understand. Pension obligation divided by salaries and wages. Well, what do you want there? You certainly don't want it increasing, you want it lower, right? That's your net pension obligations. And the same thing applies to your liability for post-employment benefits. Everybody see that? Okay. So, and these are probably one of the biggest issues. These two are the biggest issues that we find. Capital outlays from operating funds divided by operating expenditures. So the question here is, do you want more, less, or some other measure? This is a question you can only really answer by looking at a trend over a period of time. Let me explain to you. If 10 years ago you spend 10% of your budget on capital related costs and you spend 1% today, what does that tell you? It tells you there is a problem. What have you done? So that you could pay your operating costs, you have reduced your capital expenses. Not a good idea. Again, this is a trend that you have. Since you're so good at this, let's take a look at this, a problem. All right, let's take a look at a problem and see if you can figure this out. And it's a very simple one, but all right. So what I'd like you to do is read the question up on the top. Okay, so basically what you're asked to do is you've got three choices. You could put a plus if it means that it indicates stronger financial condition, a minus if it's weaker, and any if it has no effect. Okay? So let's take a look at number one, unfunded pension liability. Plus, minus, or any? Minus. Right? Got it? Okay. Level of overlapping debt. We haven't looked at it, but what do you think? Debt is debt. Plus or minus or any? Minus. Reserve for self-insurance. Excellent. Intergovernmental revenues. Plus, minus, or any? Intergovernmental revenues. What does that mean? Grants, right? Grants are what? One time, right? So that's why we call it minus. It's intergovernmental revenues. Level of business activities. Plus or minus? Well, if you have more business activity, what happens? It's supposed to be better, right? Okay. Education level of citizens. Now we're getting into, and the people can argue about this, but what do you think generally? Plus. Unemployment rate, plus or minus? Remember, unemployment rate, so it's minus, right? Not employment rate, but unemployment rate. Restrictions on revenues, plus or minus? Excellent. Personal income per capita, plus or minus? Great. Inflation rate, plus or minus? Minus. Higher the inflation rate, the worse things are. Percentage of households below the poverty level. Short-term borrowing. Minus. Property values. Population growth. Population growth. It's NE because we don't know. We don't know what that does, right? How about this? Political party of the mayor. He said minus. Okay. All right, we'll be politically correct and answer any. But I know each one of us know what the answer is, right? So it is any. But so you get the gist of this, right? This is how we kind of look at this. Okay, any questions so far, by the way? Notice the heading, measures from government-wide statements, right? What I expect you to know is what these are and what they mean, and that's why we have the explanation. Unrestricted net position, which is how do our rainy day funds look like? Capital asset condition, how much useful life do we have left in our capital assets? Pension plan funding, will we be able to pay our employees when they retire? Debt to asset, who really owns, I like that, who really owns the government entity? And quick ratio, how is our short-term cash position? Now, for each one of these, you should know how the ratios, how these are calculated, okay? And there are some, it's on, let me just show you where this is, and okay. Oops. 428. Okay. So this is what I like you to, please make sure you put a little asterisk here because this is important. You need to know what the indicator is, what it measures, and how it's calculated. And obviously you need to know what it means. In this case, each one of them is pretty straightforward because we know, just going through what we just did, what a higher or lower number might mean. So these are shown on the 2 pages on 428 and 429 and describe that. And the ones that I showed you earlier are on page 424. These are the ones that we were talking about, revenue per capita and what they mean. It's not enough to know what the ratios are, but you should be able to interpret them. Okay, any questions so far? Does everybody see this? Is this rocket science? No. This is probably one of the more easier areas of the course because it makes sense. All you need to do is you need to understand what what the terms mean. Okay. So moving ahead, these are some more ratios, changes in net position. We always want to see how it's changed, improved, or declined, or remained steady over the past year. So let me ask you this question. If you were the treasurer of a state, and despite all the gloom and doom I've been telling you about, if you've read the recent stories on the financial conditions of the states, things are turning around. Actually, some of these folks are going to have budget surpluses because they were ready to, they threw in the towel and really budgeted very low numbers. And because of the turnaround we've seen in some areas, some sectors of the economy, things are turning around. Now, if you're the treasurer, what would you do? You've got a couple of choices. One is celebrate and say, you know what, I'm going to use this money to do all the things that I couldn't do. Second is to say, you know what, having gone through what we just did, maybe we'll take a portion, but the rest of it, let's put it away in a rainy day fund, right? And these are the decisions which the state legislators are faced with. And the smart ones, think about, just in your mind, conceptually draw a graph where what you have is expenditures. Do the expenditures change because the economy is better or worse? Well, it does, but you have to provide certain basic level of services, right? So you've got that stable thing. But what changes? The revenues change. So what you want to do is you want to set up your rainy day fund to fill in the gap between your revenues and expenditures during years when you don't have sufficient revenues. Yeah, Justin.
I was thinking on like a federal level.
Yeah.
You kind of have the current trend has been to support the economy in recession.
Yes.
But also to like cut taxes and things like that when the economy.
Yes. And you know what? It's a very good point, but the issue, and this is, and I should have, and I'm glad you mentioned this, because we're looking at state and local governments right now. Federal government is a whole different issue, because what you're talking about is macroeconomic policies. If any of you, if there's one subject you should study besides accounting and all it's macroeconomics, because it will truly give you an appreciation for how the economy works. But from a macroeconomic perspective, you're absolutely right. What happens is there's a school of thought which says that in order to prop up the economy, you need to make investments. You need to push money into the economy, which is done exactly at the wrong time, right? When you can least afford to do that. So, and there are these two schools of thoughts. If you go to Europe, look at what's happening in Europe. It's the totally opposite thing. What's their reaction? Their reaction is what? Cutting back their budgets dramatically, and therefore doing what? Unemployment rates are 20%, in Spain, for instance, or more, 20 to 25%. So in the US, we've taken the exact opposite approach. Japan is a whole different issue. Their economy has been lumbering for over 10 years. And they, short of giving everybody cash, they haven't figured out a way how to get out of it. Because they are in an environment where people aren't spending. They are saying, you know what, instead of buying this today, I'll buy it a month later because it will be cheaper. They're in a whole different psychology. And it's a big issue there in cases like that. But so with federal government, they have the latitude to print money, which state and local governments don't. And because of that, yeah.
But I also think like the template's kind of set at the top because like you kind of have this issue where they're really messing with the interperiod equity.
Absolutely. You know what?
Trickles down to the
Absolutely. I mean, just take a look at our debt. Take a look at our debt. Think about what happens if the interest rates, and this is not a lesson in economics, and I don't mean to go into that area, but think about what happens with a 1% increase in interest rates to our interest payment on national debt. 1%, just 1%. We've been able to afford this debt because when you go, you're lending money, insurance funds are lending money to the government, treasury notes rates at 1% or less. You just have to go into Bloomberg and you'll see the rates. And so it's a whole it's this whole issue of what happens if the interest rates begin to increase, which could happen if there's inflation in the economy. And that's what saved us. But again, not to digress, but interperiod equity at the federal government level is definitely there. And it's not only interperiod, as I said to you before, it's intergenerational. Our generation is passing that on to the generations below, this debt as a present. That's what's happening. And that's what, but yet we don't know how to get out of this. Okay, we don't know how to deal with this issue. So that's on the interperiod equity. Now, business type of activity, self-sufficiency. Well, remember I was showing you the example of some of the transit agencies. You need to cover the cost of your business type activities. That's why they're business type, because you're supposed to do what? Cover the cost of that activity. The only problem is if you're running a transit system and you try to cover the cost of that activity and your train and bus fares go up by 200%, what's going to happen? It's not going to happen. Not good public policy. So that's an issue we have. Debt service coverage, pretty straightforward. Were our revenue bond investors pleased with our ability to pay them on time? During all this time, I didn't tell you one thing, which is that a lot of governments, before they sell debt, they go and get a municipal bond insurance company to insure their debt, if they're in trouble especially. They won't be able to sell the debt without going in and purchasing bond insurance. But a lot of them don't. We'll take a quick break after this one slide. Revenue dispersion, how much of our revenue is beyond our direct control, and this is what I was talking to you earlier about one-shot revenues. Debt service load, how much of our annual debt goes to pay off long-term debt. And what I'd like you to do is someday when you look at some federal numbers, look at what portion of our budget, federal budget, goes towards servicing debt. Bonded debt per capita, what is our long-term general obligation? I don't know what that number is. I know it was quite high, but it'd be interesting to see what it is at the federal level. Legal debt limit, can you issue more long-term general bonded debt if needed? A big issue with some municipalities. You need to do something, but you have reached your debt limit. Can't go issue debt. So what do some people do? They go and sign on to capital leases which are outside the debt margin calculation. Property taxes per capita. What is our tax burden on our taxpayer? And this is information that's widely available. So let's take a quick 5-minute break and then we'll come back and finish this. Okay, let's get started. Do you see anybody outside? Yeah. Okay, I think I finally figured out the reason for some of the looks I got is because you have another exam coming up. Okay, I just found that out. Okay. All right, thanks. Okay. All right, so let's just pick up from where we left. So we've looked at some of the ratios. Now the question is, what do you do with those ratios? And the next process is the process of benchmarking, which is basically comparing the results of your ratio analysis with something that makes sense. And this is where the issue comes in, is what do you compare this to? And the reason for this is very simple. You hear the expression, no two towns are alike, no two states are alike. However, services are similar. You just cannot buy that argument. You know, people say, well, you know, you can't compare us with another town. It's yes, there might be something to it, but that's not the whole story. And the reason, as I said, is because of different socioeconomic factors. That's one reason why you can't compare them, and because of the size. So with benchmarking, interpreting these ratios are really the key, because without that, it just won't make too much sense. So what do? You look at the ratios over a period of time. You don't look at it in 1 year, you look at it over a period of time, and you benchmark them against average data for similar governments. Now there is an example of this which is shown, one of these indicators on page 430. If you just make a note of how the analysis is done, okay. Let me see if I can just quickly show you. So here is an example of the surplus in the general fund for this town over the past 10 years. And nothing like a graph, because it shows you, this is on page 430, it shows you what's happened over those periods of time. Yeah. Oh, sorry. You're too polite. Okay. All right. All right. So this is the, just take a moment to take a look at this indicator. And this is what happens for each of the indicators which I showed you. A sheet is prepared which analyzes graphically what the warning trend might be, okay? And then it shows you the 10-year history. Now, what can you tell me about this on a 10-year historical basis? What you've seen is that it's declined from 2001 from 6% to 1.2%, and it's been running at a very low number, the surplus itself. So they're just making their budget. They're just doing it. They don't really have too much of a surplus that's there. And there are explanations in this, and so I'd like you to just kind of get the idea of how each one of the indicators we looked at, again, how it's presented. Now, this doesn't have to be done by a rating agency. The CFO or the staff of the agency of the state might do this themselves. And they might be required to do that as part of their bond offering. There is a, the book talks about this, it's called a performator evaluation on page 434. I don't expect you to know that, okay, on page 434. It's an accounting firm which came up with this methodology, how to evaluate financial condition. It's proprietary, but it's got some things which are not the best. So we will skip that. That's on page 430. Okay. So to wrap up this area, let me ask you this question. What are in your mind, what are the 5 areas that you would look at? What would you look at as if you were to measure or evaluate government financial condition? What are some of the areas? You'd look at revenues, right? You'd look at what? Expenditures. What else would you look at? Debt. Good. What else? Major areas. What? I'm sorry? Capital expenses. What's another major area that we... Unfunded liabilities, right? So what I'm trying to do is give you some general categories within which to work, okay? But this is, you know, these are some of the... Liquidity is another issue, is being able to meet its obligations, and as you said, capital costs. Okay, so going back to this, credit analyst model. So what happens if you work for a bond rating agency? What do they, first of all, where do they get all their information from? From the CAFRs. And they have other sources, right, for information. They get them from CAFR, and they have other sources of information to look at, and they build their own models. I can't present to you the models because they are proprietary. They've been developed over the years, and that's what they use to assign their ratings. Starts from AAA. I think the last investment grade is BA, okay, for bonds themselves. And each day, for instance, I was just looking at it before the class, Moody's, through their U.S. Public Finance Group, it's a huge group, issues the ratings on the different issues. Okay. Again, if you're on Bloomberg, you'd be able to get all the information behind each one of those ratings, and the, you know, but this is how they are assigned their rating, and this is published each day for the investors themselves. And these are the factors which we talked about, you know, debt, finances, legal security, what is the debt's legal security, economy and demographics, and management strategy. So let me ask you one question. I want you to think about this. What's the fundamental difference behind somebody loaning money to a company and loaning money to a government? What's the one fundamental difference? Yeah, that's right. With a company, what happens? They can declare what? Bankruptcy, and you're out of luck. With a government, what happens in most cases? They are forced to, as you said, raise the money through taxation. And if the burden gets so much that they just cannot afford to do it, then they declare bankruptcy. But in most cases, that's why if you look at the interest cost on public debt, it's so much lower, not only because of tax-exempt nature of the debt, but also because you have this ultimate security that in the worst case scenario is what? They'll raise the taxes to pay off the debt. And that's the debt's legal security that we speak about. And we talked about each one of these, so we won't go through all of this. But what I have to tell you is, when you look at the debt ratings on bonds, it's a snapshot in time, right? It does not reflect the degree of change that could occur. So you have to be very careful the way you look at this. Look at the debt rating itself. And don't rely on the debt rating to give you the whole story. You know, I don't, after what's happened to us with the debt rating fiasco, I don't have a whole lot of confidence. because whenever, and I don't mean to say anything bad about the rating agencies, but whenever the rating agencies are paid by folks they're rating, there is a problem. There's a conflict issue which I see, which is, and it shouldn't be so. They've cleaned up house. They've done a lot of things to make things go, to have more controls. But that's a fundamental issue. But thankfully for governments, that's not a major issue. Interpretation of financial analysis data. Again, if you see some bad numbers, you'll know. It doesn't take a genius to figure out looking at trends, because it won't be just one area, it would be multiple areas which will show negative declines or will show problems. These are, we talked about signs of fiscal distress, declines in revenues relative to expenditures, declining property values, declining economic activity, erosion of capital plans, level of unfunded obligation, and capital expenditure. So as you see, there's not a whole lot, but these tell the story in these principal areas. Okay, so any questions, by the way, so far as to what, and really it's no more complicated than what I just told you. There's no rocket science to this. So let's take a look at a couple of other things. Let's see if you can answer some of these questions. All right, let's go to our, oops, wrong one. Okay, let's do, I want you to take a look at these questions. Oh, I'm sorry. Yeah. Yeah, own source, from their own. Okay, so the answer, oh, you want it bigger? Okay. Okay, that's better. Okay, so let's take a look at this. Anybody need any more time? Everybody answered? Okay. Actually, most people got this right, which is a decreasing ratio of total revenues to total expenditures, because the question was, what's the sign of fiscal distress? Any questions on this? Okay, let's take a look at the second one. The question is if it was low, not high, if it was low. Do we have everybody? I think we need one more. Okay. Actually, the class is doing excellent. It is B. Anybody not understand this question as to why? Remember, the question is if it were low, right? Okay, let's go to the next one. This is pretty straightforward, so I hope we get 100% on this. Okay, we need two more. Okay, where's the last person? Okay. How many say 100% of the people get this right? Well, that's close, 91%. See, I knew that. There we go. There, see? Great. I knew that. I knew that it was 91, and I knew that it would be 100%. Okay. All right. You like that, Caitlin? I see you. Yes. Own sources, its own taxes, its own, not one time, but its own taxes. From its source, from the government itself, from itself. All right, let's take a look at the next one. Okay, this one we just covered. Okay, I'd assume this would be 100% too, but there are three people. Bless you. Three more people. Taking too long to go through the book. Okay. All right. Okay. Excellent. All right, and our last question. Okay. This one, you hopefully 100% here too. Now your wish is if all the questions were this easy. Okay, one more. Okay. Well, it is unfunded pension liabilities, and you want that as low a number as possible. Okay, so now let me just talk a little bit about this chapter's CAFR assignment, the project at the end, because this is a pretty involved area. So I'm going to just go to the page which has the assignment itself, which is 441. Okay, so this is the CAFR assignment's pretty extensive. It goes through questions, but this is where I'd like you to put, this is a project by itself. So we're going to try to make this manageable. What I'd like you to do is draw a line across here. Stop right here, and don't be concerned about the requirements because you've already answered them in the top. This actually asks you to calculate all the different ratios over a period of time. So put a line across here, and you're not required to do this, A, B, or C. Okay? You'll understand it once you read it. Okay? So just put a line across right here, and this is the last thing that you would answer, and then don't be concerned about these. Okay? This is on page 441. Page 441. Okay? Because you've already answered many, many things coming to this point, and I didn't want you to have to go out and calculate the individual ratios over a period of time. Everybody got that, or everybody see that? Okay. All right. And next, what I'd like you to do is, how many of you have actually bring in a book to the class? How many of you do that? I know it's not many people, but can you read this from the back, those of you who don't have the book? No? Okay. If you have the, yes, if you have the book, it's fine, because what I like to do is, I like you to now take a look at page 442, which had 437 actually. Which is this citizen-centric reporting. Okay? And the reason why I'm giving you this is because, remember I spoke to you about the popular report before, the condensed report? Association of Government Accountants has its own report, a very short report. It's called a citizen-centric report. And what I'm going to do is, I'm going to show you, if I can find this here, a copy of the citizen-centric report for the state of Nevada. Is anybody doing a CAFR on Nevada here? No. Okay. So this is a report on the state of Nevada, and what I want you to do is, it's 4 pages long, and there is a format that's given by the AGA on what the report should look like. And this incorporates, notice the difference between CAFR and this info. And I'd like you to, as you look through this, look at what it includes that the CAFR or the popular report won't include, okay? First of all, you know, you see a nice introduction with plans for the future as to what they foresee as coming. So page 1 provides the objectives of the government, right? What the programs it's required to do. Okay, some demographic information you'll find too as we go along. Look at the demographic information here. Okay. A little different from the other reports you're used to seeing. The second page is a progress report which you cannot read, but it provides a performance report on its mission and some key, key data. So it talks about renewable energy, which is important, mining, IT, education, and these are the performance measures. You don't see this. And this is what GASB has been trying to put forth, requiring governments to report performance information, which governments have resisted. But through AGA citizen-centric, they can report these performance measure highlights. So for instance, reduce highway fatalities. Their goal is what? 0. In 2012, it was 255. 2011, it was 270. Okay. Expenditure per pupil. Their goal 9,424. They spend 8,515, and it's 7,700. And that might seem a little puzzling. What does that mean to you? Their goal is higher than what they're spending. So what would they want to do? They want to raise their educational, the quality of their educational program, put more resources, but that's all that they're able to spend. So these are interesting. Percent of roads which are taken care of each year. Their goal is 7.8%. They were only able to do 3.6%. Okay. Graduation rate. Their goal is 74%. They were able to do 69%. So see how the data is a little different because you're looking at these performance measures. Now page 3, there are only 4 pages to this. Page 3 are their revenues and expenditure information. But this is only meaningful to look at if you looked at the performance data. By itself, it makes no sense. And this is what I'm telling you people are concerned with government financial reporting. We see all these numbers, but we don't see what is the result of those numbers. And this is the reason why I wanted to show you this, because you see the performance measure, and these are just a few, and you see what's being used to generate those performance measures. And you see here operating grants, how they have changed, sales and use taxes, they're up 3%, gaming taxes up 4%, other taxes up 4%, charges for services down 8%, and other, a 1% overall decline in revenue of 3%. And expenses by function, down by 6%. So revenues are down 3%, but their expenses are down 6%. Okay. Again, what do they spend money on? This shows you that the largest amount in the state goes towards health and local services, which is found in most states. Just about every state spends on health, social services, and education. Moving on to page 4, what are their challenges and economic outlook? It gives you kind of perspective information regarding the future. They talk about education, economic challenges, and some other things, about federal grants. But do you see the difference between this and the CAFR and other things? See the marked difference? It's more readable. And this is part of AGA's citizen-centric reporting. They're part of their initiative that they have. And those governments who prepare this 4-page document get an award for making financial statements more understandable and providing more information. But no audit opinion, but some of this information does come from the CAFR. So the reason why I put this up again is the smart, some of you have probably gotten this already, that you will try to look at the citizen-centric reporting for the state CAFR you're going to do, because it will give you some more high-level information. Do you see this? So you have these different sources of information, the popular report, the citizen-centric report, besides the CAFR, to put it all in perspective. Okay. Just one more thing and then we'll stop, okay? I know you have an exam tomorrow, so we'll go back to the book, and there is this, and I know we're not going to be able to read this whole thing, but there's this case study which is used very often in government financial analysis about the city of Detroit. And if you haven't, you should look up information on City of Detroit, because they're going through some tough financial times and they're trying to reorganize things a little bit. And so I'm going to go over some of the things. If you can take a look at this on your own, I'll give you some of the pointers as you look at this case study, because they are pointers which apply to all the other things that we have covered. Okay? So when you look at a real live example, in this case, an example of a real city such as Detroit doing this, going through what it is, one of the first things you'll find out is that they have very large unrestricted net position. Deficit, a large deficit in their unrestricted net position. In the case of Detroit, it's almost $1.6 billion. Okay? And that deficit has been increasing each year. That's a sign of fiscal distress. The other thing you'll notice is, looking at this case study, is that sometimes it's the result of some poor management decision. With Detroit, the poor management decision was they're getting into hedging, financial hedging activity. Now, don't ask me why people would do that, but that caused them some losses. And which is really what you see here is, poor financial management because of this. Another area that you'll find, so it's one, large unrestricted net position deficit; two, some activity which caused issues; third, that you'll find is that they've had a general decline in their revenues over a period of time, and Detroit is one of them. Okay, they've, because of the issue with the auto industry and their reliance on just the auto industry by itself, they have experienced that problem. The other thing you'll find is that when that happens, they usually hire someone to come up with some cost containment strategies. And but by itself, it really never works. You need a whole comprehensive set of tools here. And this is the part of the case study. The other piece that you'll find out is that they are tempted to issue debt to cover their operating costs. That's another item that you will notice. The story of Detroit is the story of many cities. And that's why I wanted to go through this example, because we haven't done case studies, but what you see here is what you will find elsewhere.